Hi, everyone. Today we're going to talk about the five retirement withdrawal mistakes to avoid. And this is an important topic because it's one of the biggest challenges with retirement planning. The thing is, we go from having usually one to two sources of income, at least for most people. And then you get into retirement, and what you have is you have all these different accounts you got to look at. You have RSPs, you have your TFSAs, you have your pension, and whether it be private pensions or public pensions, you have your non-registered, just a lot of moving parts. And so the challenging thing is, what should I pull from? When should I pull from? And how do you kind of make sense of all these things? So today we're going to talk at a high level what a withdrawal strategy looks like. Now, before we get into the withdrawal strategies, I want to kind of bring to your attention the risk that is involved with retirement and the withdrawal strategies. The first one is longevity risk, and longevity risk is the longer you're alive, it's a blessing. But the challenge is there's a longer potential to outlive your risk, right? So we talk about retirement, we're talking about longevity risk, and for a lot of people, it's a risk multiplier. Now, if you have a huge capital and you're getting, enough from that where you're not touching your capital, that's great, but that may not be the case for everyone. So for people who are uh, taking from their capital and really grinding down their capital, there's a huge longevity risk. Then there's inflation risk, which I think in today's world, I think this is a bigger concern than it has normally been in the last 5-10 years. But in today's world, I think we all understand that cost of living can rise faster than anticipated, and what that leads to is eroding or taking away from your purchase power from your retirement fund. So that's another big thing. You have your investment there, you have expenses, but that expense is going up significantly. Potentially here, what we have is having a plan and not really planning for inflation. Next one is market risk. Just being in market, being invested. And I know here I have investment portfolio. Some folks are, you know, maybe invested in a particular business or real estate, whatever it is. There is market risk. There is market volatility. And the longer you are in the market, potentially there might be, something that negatively affects your investment portfolio, right? And as an extension of that, what you have is called the sequence of return risk. And that's really about the timing of the returns. Because if you have a long term investment, you may have fluctuations, you may have negative periods. But what's even worse is if during those unfavorable times when you have a down market, you have to pull from those funds. And this can disproportionately negatively affect the long term performance of your portfolio because you haven't allowed your portfolio to increase and come back from that negative period. So with that in mind, from the risk standpoint, I'm going to talk about some retirement withdrawal strategies, and these are some of the things that you could do to avoid the mistakes that I've seen. The first one is not planning early enough, right? So if you're not planning early enough and you just jump into retirement, or maybe you're already deep into retirement, and now you're looking at withdrawal strategies, because your portfolio hasn't been set up properly, it's going to take some maneuvering. And so what happens is this causes potentially more challenges and, you know, maybe not even the most tax efficient situation. And it's great. You may have done a great job in terms of building up this portfolio, but now we're at a place where we have to move things around for tax efficiency purposes, right? So not planning it early enough is a big thing. Now, depending on your circumstances, it could be 5 years, but I would say give yourself the opportunity to look at it at least 10 years before and get some advice and put a framework in place and have that structured such that you can, put your portfolio in a place where you can, be in the best position for withdrawals and not, by the way, avail yourself for being in a position where you are dealing with all the risk that we have before. And if we are able to sit down 10 years before retirement, we could look at your entire situation and start to plan towards that and avoid a lot of those risks. Next one is underestimating your financial needs. You got to get really grounded in your expenses. And a lot of times people, kind of pull a number out of the air. I've seen it before. It's like, you say, okay, so how much do you need for retirement? Sometimes it comes up early discovery session. People tell you a number. It's not really grounded, meaning it's not documented. There's not a budget in place. You don't know exactly what your costs are, your expenses are. If you understand what your expenses are, then that's a great place to start. And then we look at how much more expenses will be increased in the future, or maybe in certain circumstances, how much more will expenses actually decrease, right? And if you're not grounded in that, this could lead to a mismatch between your expected needs and the actual available funds. I would say available funds, it may be that you have the amount in the investment portfolio. It's just that the amount in the most tax efficient way to pull from the portfolio may not be the best way, as well as you just may not have enough funds too. But you got to get really grounded on your expenses and how much you need annually, right? Next one is, once you've identified how much you need annually, the good thing is you start to separate your short term income needs and have that separate from your long term investment portfolio. What do I mean by that? So, what you want to have is a certain way, a lot of people call it a cash wedge, where you have a certain amount of funds that is accessible to you over at least 1 year period that is not participating in the market and not not faced with the market volatilities that often happens. And quite frankly, if you are going to retire, say 55, 65, depending on how long you live, you will your portfolio will be exposed to market volatility and probably even a couple crashes in the process, right? And you will obviously need income during that time. So what you want to do is structure it in such a way that you have at least a 1 year we call a cash wedge, a 1 year amount that's put aside, that is not in the market and that will not be dealing with that market volatility. And then you want to have 2 to 3 years worth of expenses in some type of a fixed return, some type of fixed income that is guaranteed, which means that, and sometimes it could be a GIC, but whatever it is, some type of fixed income, again, that is protected, earning a decent amount of interest rate, right? Some people could be bonds, depending on the circumstances, could be even a high interest savings account. A month ago or so, there were great opportunities, even a couple of weeks ago, with a decent return that you could have, right? You could lock some things in. So this is a great opportunity for you to separate your short-term income needs in terms of 1 year, 2 year, and 3 year. You probably want a 1 year cash wedge, and then for the second year and the third year, you want to have that in some type of fixed income security, something that's providing some decent interest rate, well, as good as you can, and not have that money be a part of the market, because if you have to sell that off and the market's low, it's essentially a double loss, right? The market's already low, you're pulling from your funds. It doesn't give your funds the opportunity to bounce back, right? So again, this is not necessarily going to be, in many cases, a huge significant part of your portfolio, because you still want to have a part of your portfolio participate in the market, having the opportunity to gain returns. But for the amount that you need for the next 2 to 3 years, you definitely want to put that aside. No, once we establish it, we need to actually implement it. Because a lot of times it's one thing if you have a plan, it's another thing if you're executing on the plan. So I wanted to go this extra step to say it's one thing if we identified it, but then we need to have the proper asset allocations that reflect what we have identified, right? And again, this protects from market volatility. It protects your investment, so you have a long amount, a decent amount over a longer period of time. Definitely protects against sequence of return risk, which is a big thing. What's the last one? No, we have done well. We have the cash wedge. We have probably the GICs or some type of fixed income over the next 2 to 3 years. But then we got to pull that money out. We want to look at the tax implications of all those withdrawals, right? So you're pulling from different accounts. Again, I mentioned RSP, TFSAs, non-registered accounts, pension plans. You're getting funds from all these different things. But realize that if it's not structured properly, a lot of the benefits that you may have had, for example, if you contributed to RSPs and you got some deductions, I know you're pulling from the RSPs when you're at a higher income, potentially you're going to be paying higher taxes. Now, you would have had the benefit of having tax deferral for that entire period, but no, you're getting taxed at a higher rate than they actually contributed. And for a lot of people, it's not a fun thing. In fact, I could tell you, this is one of the biggest pain points for retirees. So you may have all these things in place, but you have to also be strategic in how you withdraw from those funds. So you've done a good thing by having asset allocations in place. Everything's great. But now when you go to pull from those funds, you have to look at the tax implications and plan that out at an annual basis. and sometimes even revisit, because I've seen in the past where, in the more recent past, where because of inflation, you have a certain plan in terms of what your budget will be, and mid-year things just go crazy because of inflation and things of that nature. In addition to that, things happen, right? You have unexpected expenses, you have family members you may want to support, things happen, you revisit it. Hopefully this was helpful. And again, these are pretty broad strokes. Everybody's situation is going to be a bit different, but this is a pretty good, I think, framework that you could use to see if you're on track. Now, what I would say is I strongly recommend that you work with a professional to get these details grounded and make sure that you're using real numbers and that it makes sense and the tax implications don't affect you, and you're not, having your portfolio in the wrong things. So work with a financial planner. You can reach out to myself, or if you already have one, make sure that this process is taking place. This came about because I'm having conversations with a potential client, and we're having conversations about withdrawal strategies. So I figured I would just share this information. All the best. See you next week.